You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to the Investing Matters podcast. My name is Peter Higgins. You can find me at Conkers3 on Twitter. And today I have the absolute privilege of speaking with Jean Roche, one of the leading fund managers in the UK and the lead manager of the FTSE-listed Schroder UK Mid-Cap Fund, and also one-third of Schroders UK Small Mid-Cap team with Andy Brough and James Goodman. Welcome, Jean.
Thank you very much. Very accurate introduction.
No, it's fabulous to have you on here, Jean. You've been an absolute delight to listen to over the years, and you've, as a performer, regarding the fund management team and fund managers per se, you've absolutely smashed it for long-term investors. So very well done in what you've achieved so far. And you've got plenty more years of delivering good value for everybody. So I'm thrilled to have you on here. So thank you.
Well, I've been very lucky to work with some of the best in the industry, brought into Hargreave Hale initially, and then, which is now part of Canaccord, and now working with Andy Brough, who I think said a few words on the podcast for you, a year ago. So, I stand on the shoulders of others in many ways, but many of us do.
As we all do, and you're absolutely right. Andy was here on here a little while ago, and we spoke about the Heineken Index, which I'm sure we're going to touch on it again a bit later on. But I wanted to talk briefly. You mentioned there about your first experiences, and you were a graduate of the Morgan Stanley program. So tell us about that, because it's also linked into what you first studied at degree and master's level as well, because you are a bit of a person that loves your numbers, aren't you, Jean? Yes.
Well, actually, I was thinking about this. It kind of stems back to my dad, who always said he did a degree in mathematics in the National University of Ireland, Galway. And, he kind of said to me, well, if you can do maths, then, you'll always get a job in maths, because lots of people don't like maths. And then there was a general thing about doing what you like, what you enjoy as well. So I did maths and French as a joint undergrad, and I really enjoyed the difference between those two as well, actually, and the fact that I got to live in France for a year as part of doing that undergrad. So that was very enjoyable. And then when it came to doing a master's, I had to decide. So I was signed up actually for a master's in French literature. That could have been very different. And also a master's in financial and industrial maths. And I went on, it was literally the last moment I decided, if I want, the lifestyle I would like, I probably need to do the master's in maths. And so I went and I did that in Dublin City University. And that really opened doors to many of the milk rounds. But I'll tell you, it'll tell you how naive I was, really. Although I really enjoyed, games like, I liked betting on the horses. I'm from the west of Ireland and down the road from a race course. I really liked playing with the roulette wheel and all the normal stuff that kids play with as well, not, Barbies and things like that too. But, I quite like numbers games, probability, breaking codes, things like that. But I decided that when Goldman Sachs came to our university, I wouldn't try there because that was too famous, But I thought when Morgan Stanley came along, I never heard of them, so I'd apply there. So I applied to Morgan Stanley, and I applied to a few others, and I got a couple of offers, and I thought, I'll get to go to London and I'll go for 2 years. So here I am 25 years later after that graduate job at Morgan Stanley, and that I joined there as a tobacco analyst. And actually so interesting having that experience in the market, because on the radio this morning I was hearing about vapes and Chris Whitty and all the changes around that, and it's amazing time in the market. The big issues around changing flavors of cigarettes back in the 99 2000, that's all come around again now for vapes and legislation and all of that. So yeah, a bit of a long answer, but just reflecting these kind of chats make you think about these sort of long-term themes and what you've seen before and what's coming around again, which is a very big part of investing.
Indeed. And amongst that journey, Panmure Gordon, as I think you said there, Hargreave Hale, all the rest of it. There's a little bit that you missed out regarding a certain award from Wall Street Journal, maybe.
Yeah. Well,
award winner on our show, ladies and gents.
Yeah, it feels like a long time ago now. It's a bit like saying, "Oh, I got my sort of grade 8 piano exam," you know. But and the 100 meters fastest runner or whatever it is when I was 13. But or was it three-legged race? But yeah, I was the Wall Street Journal Retail Analyst of the Year in I don't even know what year it was now. Maybe 2003. But it was all to do with this trend of online retail, and it will never take off. And it was a lot of it was down to that whole shift online. And in the beginning, nobody believed that anybody would ever buy anything online. Everybody would want to try it on. It'd be too much of a pain to bring it back to the shop. And those were the early days of the trend. And we've seen it come full circle since. But yeah, a lot of it was down, as it often is. A lot of that award, it was down to very much performance, but it was very much down to one or two stock picks, and ASOS was a big player in that, because that through the GFC, ASOS was just rocketing still, and that's what's so interesting about small and mid cap investing, because these things can work. The macro trends just don't affect them as much because they're starting from a small base and then they're growing like weeds, to use the technical term.
So yeah, this is the beauty of you being at the forefront and seeing things, where other people's are going, no. It's about having that sort of viewpoint where sometimes you've got to challenge the consensus, if anything, sometimes, and go, actually, this is a possibility. What if, So yeah, and you were there doing that 21 years ago, and look at online now. It's a force to be reckoned with. Only second only to AI probably now,
Sure.
So Jean, we've covered a little bit about the backstory there, a couple of your roles as well, and then you get the offer, or what happens regarding getting to Schroders? What's the story behind that? Did they come to you? Did you see them? Did you just think, I want to work with Andy Brough? What happened?
It was absolutely, I want to work with Andy Brough. So what happened was, I was very, very lucky to be asked to move to the buy side when it was just thinking back now. So that was 10 years ago, a bit more than 10 years ago now. And I had always wanted to do that. I'd done the CFA. I'd had 10 years on the sell side, 4 years in government, which I highly recommend as well, actually, because it gives you a very well-rounded view of how things are run. And I just had a phone call one day from the team at Hargreave Hale saying, we'd like somebody to help on the fund. And I absolutely jumped at it. And I was very lucky to have a couple of years there with Sid Chandlal and Giles Hargreave and the rest of the team there. And then I'd always kept in touch with Andy, who I used to broker to actually for many years, and particularly, in fact, talking about online retail was where we got talking, because he's a very big believer in speaking to people who are spotting the new trends, and not assuming that you know everything, and just picking up something new from every kind of meeting you go to. There was a space coming up in the team, and he's a big believer in having diversity in the team, and he was looking for a female fund manager. And as you'll know, Peter, because I think this is close to your own heart as well, what are there, 11% female fund managers, and that's a kind of a global figure, really. The UK is no worse than anywhere else, and he wanted to replace a departing fund manager on his team with another woman. So I'd like to say probably the field was probably not that wide, but anyway, we had a chat about his investment philosophy, which I think he's run through on this podcast before, actually. Sort of buying and holding these unique stocks, the A's, then maybe trading in and out of the flex stocks, the B's. And I can talk about that a bit more later. And then avoiding those C stocks, the ones where management is destroying value. And he in true sort of legendary style, he drew it all out in a napkin and said, "What do you think of this philosophy?" And I thought that makes a lot of sense. And the fact that it fits on a napkin, probably, very a good sign as well. So I was able to buy into that. So I joined the team, and that was, nearly 8 years ago now.
Fantastic. So tell me about the initial role. He sold it to you on a napkin. So what did you say? What was going to be your first role, initial role within the team, responsibilities, etc., and how that's evolved since then, Jean?
Yeah. So actually, what we said was the main thing to focus on, and you mentioned the fund at the beginning, Schroder UK Mid Cap PLC, which is an investment trust. That was kind of the main thing that Andy wanted me to work on. I was quickly named co-manager with him on that fund, and now I'm lead manager on it. The board rode in behind me, and Andy did a few years ago and said, right, you can take over as lead manager now. Still managing with Andy now as co-manager. And it was very much, working on mid-caps. So the challenge was to develop an encyclopedic knowledge of the mid 250 index. So that would be the FTSE 250, excluding investment trusts. Now, actually, that is only about 170 companies now. There are so many investment trusts in the index. So all I have to do is pick the best, roughly, in the fund we have about, at the moment, about 50 holdings. So I just need to pick the best 50 out of 170-ish. So, very straightforward. Pick the best valued A's and B's out of that, or unique and flex stocks. Avoid the C's, or the stocks to avoid category. And, so hopefully it's a fairly easy one to explain anyway. But as you know, the realities of doing these things and avoiding emotions, trying to be rational, avoiding knee-jerk, all of that stuff, and being disciplined about selling, which I'm sure we'll talk about a bit later, is extremely important as well.
Absolutely. There's no greater challenge, I think, than navigating the market, and doing it over a course of decades is near on impossible. So the fact that you, Andy Brough, and the rest of the team, James Goodman and co, have been able to navigate it and return, substantial returns over the long term for investors is exceptional, Jean. So kudos to you and the team for that. You touched on it a little bit there. I want you to go a bit more into detail if you can for me. You've got these 170 stocks, and you're trying to pick the best 50. You go through some of the characteristics regarding the screening process and methodology that yourself, Andy and James go through to select those core 50, please.
Yes. So what we'll do is we'll take all the stocks, and of course it's a very exciting index. You mentioned the Heineken index, I think, earlier. So the reason we call it the Heineken index is because it refreshes like no other. And you have to be I realise now, when I've presented to slightly younger audiences, they don't know anything. They do not know about that Heineken ad. They don't know what you're about. But what you're trying to say is every quarter the index changes because you've got stocks going into the FTSE 100, coming out of the FTSE 100, being promoted from the small cap, and being demoted from the FTSE 250. And then you might have IPOs, M&A. So I think there was one quarter where there were 28 changes that not in my time in the mid-cap, but in the last 30 years. That is possible. It was probably, maybe it was around the time of the GFC. I don't know, but it can be. So the 170 changes, that's the other part of the game as well. So, so what we do is we take each stock and we categorize it into a unique stock, or a flex stock, or a stock to avoid. And what we're looking for with the unique stocks are companies where supply is less than demand. So there is a scarcity value. And classic stocks in that vein might be companies like 4imprint, which makes promotional products, or Games Workshop, which probably a lot of the viewers know. They're one of their main brands is Warhammer, and they make those plastic figurines that you can spend hours and hours painting and then playing war games with. And they've actually had an interesting agreement in principle with Amazon recently as well to do more stuff on screen as well. Which is, the details of which are still being worked through. So that would be, your unique stocks. They would tend to have very high gross margins, and they're very strong management teams. They would generate a lot of cash internally. They might be very capital light models. And, I think, but, you have to be buying them at the right price as well. So we would buy and hold those ones. We would flex in and out of them as well. But, there are no sacred cows. If they get too expensive, we would absolutely, unique or not unique, we would sell them if they became too expensive. And then you've got your flex stocks. They'll be at a strategic crossroads often in their life cycle. It may be that the supply of what they do is coming out of the market. So that might be the case of, for example, pubs, or the supply of shares in the market where they're buying back lots of their own shares. So there's scarcity value there, or pubs where you've got, several thousand closing down every year. So I think there's a limited something like 20 years of drinking time left or something. But
don't say that.
Yeah. Is that the time? So, they would tend to be you would expect to be paying less for those. And for the unique stocks, the thing I forgot to say about the unique stocks as well is often they would be very typical acquisition targets by virtue of being unique. And one that went off the market last year was Decra. That was unique in the UK market, and that's a farm animal and companion animal pharmaceuticals company. And that would have been your classic, came from the small cap, went through the mid cap, went into the large cap. We sold it when it went into the large cap as part of our selling discipline into the FTSE 100. But that would be your classic, there was nothing else like Decra in the index, and that's unique. And then, so I had moved on to the flex or B categories. We tend to trade in and out of those more. You tend to pay less for them probably. And they might not have, such high margins as the unique stocks would. And they might be more cyclical in prospect, maybe the house builders, potentially a bit more in the regulated sectors or the sectors which are more affected by government policy, for example. So it's, and then when you move on to the C stocks, as I said, they would be companies where management is destroying value, where there are accounting issues. It might be, several acquisitions have taken place, companies where there's a difficult balance sheet situation. But that list tends to be quite small, actually, because generally speaking, in the UK, we have very strong corporate governance, and the market regulates itself really. So that those situations don't go on that long, actually. So that stocks to avoid list does not tend to be very long. So it's, mostly the A's and the B's, and then we select the most attractively valued of the A's and B's. And we like to have anywhere between 40 and 60% A's or unique stocks. Now, I'd love to have a whole portfolio of unique stocks, but I think, you can't, we don't have that situation right now. And I think to explain the flex a bit better as well, there are areas like, for example, staffing. So you'd say Hayes and Page Group, they would say they're very different companies. However, it's very similar drivers. So you could never say that either of those are unique. So even if they had the high margins, they wouldn't have that unique characteristic whereby it's the only way to get exposure to that theme. So I hope that explains the two main categories, the flex and unique stocks that we put together to combine to make our portfolio.
Brilliantly explained. Thank you ever so much. I'm going to get into more detail about on a more forensic level about some of the stocks that you hold a bit later on. But firstly, I want to talk about something that was mentioned some time ago by yourselves and Andy, and it's one of the often overlooked real skills of investing in stocks, and that's learning when to sell.
Sure.
Other than takeovers and promotions into the FTSE 100, how do you and your team identify when to trim, reduce, and sell a particular holding, Jean? Because that's one of the skills that there's no books really out there to teach somebody.
Yeah, and you get so many fewer emails, from brokers telling you to sell stuff as well. It's all about, the vast majority is buy, and for various reasons, it's more interesting and more, I guess the human condition means you'd much rather tell someone to buy something than say, oh, you hold this. By the way, I think you should sell it, and then, I want you to be happy that you've heard from me and I'm telling you that you're a big holding, you should actually sell it. So, the brokers aren't really, it's just not human nature to tell you to sell. So you have to have a set of rules. So we talked about stocks being promoted to the FTSE 100, and it's worth talking about that because often that is as good as it gets for many companies. There are ones that continue to go on. For example, Halma, I would say, a very strong industrials company in the UK. But, as a general rule, it tends to be a very good signal as to when things have got too hot. Maybe you're looking at peak margins. Maybe you're getting to a point where competition is starting to come in. Companies like Rightmove, for example, they were the only game in town for a while until they weren't. And now we're seeing what's happening with CoStar. So, that's the point about that's a very good catalyst being promoted to the FTSE 100, because other things are starting to happen in the sector by then. Competition is starting to creep in. So, that's maybe it's going to the FTSE 100, or maybe competition. You're starting to see a lot of competition in the sector. Maybe you think it's peak margins, maybe it's peak valuation, maybe there's a change of management. There might be, so that we talk about a change of, say, ESG or sustainability behaviour. So that's often to do with the change of management. A key one is doing a high number of deals unsuccessfully when a balance sheet becomes challenged. So we do we have a lot of reasons. There's a lot of holes for companies to fall into, and we're constantly checking. And we're very much a team of printing out the accounts and going through the numbers. And if the accounts, frequent exceptionals would be a key reason to sell. Frequent and significant exceptionals. And there's a product actually called Quest that one of the brokers has, and they just do something called accounting blobs, and that's a technical term for anything that looks a bit messy on the accounts, things like unusually low tax rates, frequent high levels of exceptionals, cash flow that doesn't add up properly, profit that doesn't convert to cash, things like that. So those are they call accounting blobs, and that can be a very useful screening way, actually. So if you want to say, well, I'm looking at these 10 companies, this one has 6 accounting blobs and this one has none, or this one has 3 new accounting blobs, say, for example, that can be a useful way of screening. So, I think we kind of have to tell each other, because the brokers aren't going to necessarily tell us too much about selling. We like to come in the morning. I sit with James on my left and Andy on my right. And we like to, picking holes in things. I've read through these. This is look at this thing they're saying here, or, they're saying this is a record year. Oh, it's a record year. Well, so what does that mean for next year then? Really? Record margins, so it's all of these things. Okay, so what happens next after that? So, or, simply, this has gone up a lot. The PE is double what it normally was. Is it a different kind of company? Is it really that much better than everything else in the sector? Does it deserve to be on 20 times when everything else is on 10 times? And sometimes they do. But, we like to, go through things. And then equally, a stock could report, shares could be down a lot, and we'd go through it and say, I can't see any rational reason why this is down. We hold our nerve. And this is why it's so great to work in a team. And the number 3 in a team seems to work very well also, actually, I find.
Brilliant. No, like you say, you've got, yourself, a mathematician. You've got Andy, who's, I think,
accountant,
PricewaterhouseCoopers as well. I'm not sure about James's background, but the 3 of you,
cricketer, James,
combination.
The next cricketer.
Well, there you go.
He's got an economics background. That's it's not.
Well, there you go. The 3 of you are hitting 6s out the ground all the time. So I want to talk now a bit focused now on a couple of the stocks that are in the portfolio.
Sure.
Firstly, with the long-term stocks that you remain most confident in, yourself, James, and Andy.
Yeah, I mean, probably one to mention, it's because they've published their annual report today, is for Imprint, which is a UK quoted stock, but actually well over 95% of what they do is in the US. They make promotional products. If you go to a conference and Schroders is printed on it, or, indeed, the Investing Matters podcast, if you were getting merch, you might be looking at them to get it printed for you. And there you've got very high margins, as you would expect. You've got high top line growth rate, high returns on capital invested, because they do something called a drop ship model, where they put the order through to their suppliers and the supplier delivers it directly to that conference. And, if you're having a conference on the 21st of April and the product arrives on the 22nd, well, you'll know, Peter, that's no good to anyone. You need your baseball hats, your pens, your tote bags on the day. So they have a reputation for being extremely reliable, and equally with their suppliers, they can deliver the kind of volumes the suppliers need to make it work. They'll also do workwear. So if you wanted PH embroidered on your fleece, although no fleece is going on there at the moment, I can see. But if you did, for example, want, you had a team and you wanted PH on both the the team's fleeces, they would embroider that for you. And that's actually the whole area of personalization of branding is so important. And what you would want as well is down the line, you know, when I take my Schroders mug out of the dishwasher, I don't want the word Schroders peeling off it, you know, a year later when I think about that conference. So actually the importance of quality and branding and how that all ties in together, and they feed into that. But they're delivering the financials as well. So you've got a case where you're increasing your market share from 3 to 6%. So that is obviously the top line growing incredibly strongly. You have also a market where, you know, gone are the days, unfortunately, where you can give out, quite expensive goodies to people at conferences. So all that sort of low level, let's just call it merch, there are other words for it, but, you know, the kind of less valuable stuff, but you can still give that out. But it's important that it be of a certain quality. They're feeding into that. But, you know, the last 2 years, their top line's been growing at 45%. And some of that was COVID recovery, but some of that also was taking market share, and then also being very clever with how they use digital marketing themselves, so their own use of marketing. So they were very high in paper marketing, but now they do a lot more digital, but also newspapers, and then also not just kind of performance marketing, but also brand marketing, their own brand. So 4 imprint, and it's the number 4 in imprint. To kind of be front of mind. So if you quickly, you know, they'll be feeding into the smaller sub teams within a large enterprise. So, you know, the average order is $600. So if you needed something for your team lunch next week and you wanted sort of, if we wanted Team Schroders on our hats for or Team Schroders mid-cap, say, we would be able to get that. Well, if we were based in the US, we would get that through them. So I think it's an attractive, still remains an attractive at an attractive valuation despite its high returns, high margins, and it has a negative working capital model as well, which means that it's not using its own capital to generate sales, and so that's very good on cash, which means it can pay dividends and it can pay special dividends. So you've got this sort of holy trinity of the capital growth, the dividends, and the special dividends. So that is one that we're very positive about.
And it's been a phenomenal success for decades now. And it's always been off the radar. It's not one of those stocks that you see everyone talking about. It just quietly just goes about its business, you know, and compounding for institutional and private investors. So absolutely fantastic. Now, Jean, the largest sector that the team's exposed to is industrials. Right. Other than what other stocks that you've mentioned already, what are your other favorite holdings within that sector, please?
Well, I think it's probably worth sort of taking a pause for, you know, everything that's going on in the Middle East, which is very sad at the moment, and a lot of human destruction. So, you know, with that in mind, we're looking after our shareholders. We have 3 defence stocks which are classified as industrials in the portfolio. So that is sort of a sub theme that we've leaned into. Now, originally, obviously I didn't have a crystal ball. Sort of 4 or 5 years ago when I first really started leaning more into the sector, I would take the view, and the team would take the view that defence, they tend to be, you know, inexpensive technology stocks, and you know, you'd have some of these more highly rated stocks, maybe for example like Dark Trace, which has, you know, very positive qualities as well, and, you know, is I would say unique stock. We don't currently hold it, but, you know, you can pay less and still get high technology companies. So stocks like Kinetic, Chemring, which works very closely with some of the intelligence services, but also sells sort of flares and the more what you would associate more with defence, but also working in the grey zone. In other words, the defence that's under the radar, not terrible pun, but that's less obvious. So in that zone where there's been sort of like a very quiet battle going on, it's called the grey zone, and Kinetic have actually written a fair bit about it. And then there's Babcock as well. And then there's, you know, there are others of our stocks as well, like Bodycote, which feeds into the defence industry. So I think there's a theme there. And that was already sort of inexpensive, and some very high margin products. And, you know, we've had some good, you know, high double digit top line growth, you know, sort of 10 to 15% for some of these and higher, even before events broke out in, for example, the Ukraine and in the Middle East. And we're just seeing that go further. And there being, as I mentioned, we were seeing when you see more demand than you can supply for what they do. And then, Babcock's a very interesting one for us as well, because that was one where the balance sheet was very challenged. It had a lot of fixed price contracts. And when you're, building an enormous piece of, enormous vessel, say, to then guarantee the price to the buyer, when so many things can go wrong, that's quite tricky. So they've moved more to a cost plus model rather than a fixed price, and they've repaired the balance sheet. They brought in a management team from elsewhere, which we knew from elsewhere. A guy called David Mellor is a guy called David Lockwood. They only employ people called David, they've done a very good job there. And I attended a capital markets day there about it might have been 7 years ago, and it was night and day. The one I went to about 3 or 4 months ago, the same company. It was a different venue, but different management team, with the balance sheets different, and obviously the demand backdrop is different. But that sector's been through a torrid time because quite rightly people have mixed feelings about it, and it's moved around in terms of it was pretty much becoming an investing pariah. Until people realised they wanted to protect Western democracy, but not wanting to get in too much into that side of it. But I think it's that the valuations have been supported by the fact that people's minds have started to be changed by the realities of what we're seeing unfolding across the world, really, and by geopolitical tensions. So that's a big part of the industrials. But I mean, I think it's 30% of the index is industrials of the invest, and it's a really mixed bag. It goes from Inchcape to the stocks like Renishaw, which are sort of plugged into the robotics side of things, and measuring the width of a human hair in an Olympic-sized swimming pool, and that they do a very interesting site visit, and they're one of the jewels in the crown of the UK, I think, in investment opportunity set. And then Inchcape, looking after BMW's distribution interests in South America, just still waiting for that site visit. But, I think, just very, very big differences in that industrial bucket. And I think that's one of the things I really enjoy about, you pile it all into industrials, but actually every company has such a different personality and in a different sub-niche. So, and I think those can be the really interesting site visits as well, actually, because you're not going to see it every day. It's not like, I was in M&S this morning and that was like a mini site visit. And I always ask questions when I'm in there. It's obviously not in the mid 250 anymore. It was promoted to the FTSE 100. But with industrials, it's not something you could do in your everyday job. I can't just pop in to have a look at the machinery that's being built. As an everyday member of the public.
Indeed. I think that the beauty of it as well is that you say it's so diverse. It gives you lots of opportunities to actually see something new each time you do get the opportunity to visit as well. So that's quite a unique opportunity for you there. So on the consumer discretionary side, could you give us one of your favoured stocks in there with the team's really, really keen on?
Well, I think we talk about Games Workshop a lot, but I think the one I'll talk about instead is Dunelm. And I should say that I was actually a retail analyst for 10 years, and it's very dear to my heart as a sector. So Dunelm was actually one that I covered when I was a sell-side analyst, and I remember the IPO, and I remember it very interestingly at the time, it being said that nobody will ever buy a cushion online, because everybody likes to kind of cuddle a cushion before they buy it, stroke a curtain, feel the quality of sheets, whatever it is, and that homewares won't sell online. And Dunelm has had to take some hard medicine over the years, in that it had to embrace online. And actually, that's what we see. The best companies will disrupt themselves. So what they did was they bought world stores. So Dunelm had an absolutely, I'm not sorry to say it, they literally had a shocking website. It would be a challenge to buy anything, but they went. They bought an online native company world stores, and they rebuilt themselves and they embraced the internet. And so much so that when it came to the pandemic, they were able to do a very high significance, almost, I think it was something like 75% of their normal sales. They were able to do that just by going online. No stores open, but able to do a very significant proportion of their normal sales just by having, decided to embrace the internet. You've got 50% gross margins there, tick the box, what we quite like to see, and mid to sort of late teens operating profit margins, generates high levels of cash, has a very clear model whereby they pay out special dividends when their balance sheet goes to a certain level. You still have a founder family involved, and that can be very powerful, actually. And it can be a feature. It doesn't tend to be a feature in large caps. So again, a reason I quite like SMID and mid caps in particular, because they're a bit further in their development journey. But you have a very active family still involved in it. And I knew that they were really coming into their own when I came home one day, and my husband had bought a load of stuff from Dunelm. He said it was the best price, and I've ordered it from there. And when you start seeing it, that's kind of the fun of retail, and that's why everybody thinks they understand retail and that retail stocks are easy. But I would say actually it's hard, because everybody thinks they know how it works, and actually the customer is extremely fickle, and you're hot till you're not, from one day to another. And we saw that with Doc Martin. That's been really difficult, and it's you sort of understanding, can the company keep up with the trends? And I think Dunelm is one that can, and it's never, we look at PEG in terms of valuation. That's one of my, kind of guide rails. So price earnings divided by 3-year forecast earnings growth. And Dunelm still looks very attractive on that basis. So it's got the team, it's got the demand for the product. You've had people come out of the market as well, people like Debenhams and others who were very active in homewares, and the sort of mom and pop stores. We don't have a good expression for that, do we, in the British English? So the mom and pop stores coming out of the market, it was very fragmented, and they're gobbling up market share, keeping their margins high, but not kind of gouging the customer either. And then developing, probably the travails of John Lewis have been quite helpful for them too. So by the same token, we keep an eye. If John Lewis is fighting back, then we need to keep an eye on that. So yeah, I'm making myself want to go shopping now.
No, you covered that brilliantly. Thank you, Jean. And also, you touched on technology. So, given all the traction that AI has got, what in the portfolio have you got that gives the team some exposure to artificial intelligence, if anything?
Yeah, well, I think really interestingly, the one I would point to is one of the users of artificial intelligence, and that's Man Group, the quoted hedge fund, for want of a better expression. So when I look back in my notes, actually, they said, we've been talking about AI for 10 years. And when I looked on my meeting notes, actually, I discovered that they had been, and they were calling it machine learning originally, but they're processing billions of pieces of data every day, and they're feeding that into their trading decisions. And I would say that's an application of AI, and that is still an inexpensive stock. It can be quite volatile because, they make part of their profits on performance fees, just like any asset manager would. But they're truly, I would say that's, again, an example of a unique stock, because in the quoted world, we don't have anything else like that in the UK mid-cap space. And so that would be an example of a company that uses AI very effectively and is ahead of others as well in doing that. And then in terms of, feeding into the sort of the picks and shovels, for example, I mentioned Renishaw, and that's clearly providing pieces that go into that world. And also the likes of Oxford Instruments, which has a quantum computing side. Now, you can't always make money out of that, by the way. That's, initially it's always going to be loss making. So I think that's why it's important to think about who's using AI smartly. And that's something that Schroders is also doing at the moment. And management here have been wanting to provide us with the tools so that we can use it ourselves because you have to keep up with the world as it's changing, and not try to ignore it or not be a king Canute about it.
Indeed. Now, Jean, you've mentioned lots of quality stocks there, so I've got to ask the question regarding your own personal investing style.
Yes.
And are you wedded to all things Schroder? Have you got the mid cap? Have you got the other funds that are in there? Plus the portfolio that you've got for your own savings and long-term pension?
Well, my single biggest investment in terms of equities is Schroder UK Mid Cap PLC, and you would expect that, I think. Yeah. Look at that. The dividend's a 10 bagger. Had to get that in there from 2p to over 20p over 20 years. And that, but obviously it's a growth focused product. So when I was on the sell side, very sadly, and I think actually Alexandra, who was on your last podcast, mentioned this, I could not actually, it was very difficult to buy shares in the companies I covered or in the companies my colleagues covered. So one of the first things I did when I moved from the sell side to the buy side was I bought 4 stocks. So I still have 2 of them. I'll tell you what the 4 of them were, and I'm not going to tell you what the 2 are that I still have. But
okay, fair enough.
So I bought ASOS, I bought Burberry, I bought Domino's Pizza, and I bought what the company formerly known as Royal Mail. So it's now called IDS. Yeah. So that was, single stocks. But actually, I quickly realized, because I was never allowed to buy stocks before because of being on the sell side, I quickly realized that funds were where it was at. So as soon as I became involved in Schroder UK Mid Cap PLC, I quickly shifted into that. And, in terms of my sort of investing style, it's my pension. Aside from that is, very much directed into small and mid cap funds run by my colleagues, but also, I'm not averse to buying the odd Vanguard ETF as well. You have to say it because you can't ignore it. And, value is important as well, but I'm very much a believer in active and, I'll choose, I you would expect lean towards UK, lean towards SMID, and lean towards individuals that I know, because I know how much care they take when they're choosing stocks. And I think, the issue with ETFs, and I say this, about a FTSE 250 ETF, is you're buying those 70 or 80 investment trusts too when you're buying that ETF. You're not buying operating companies. So if you want exposure to operating companies, then you need to go active in that case. So my own investing style is to buy collective because I think that makes absolute sense. And then a part of it as well was having, I moved around between a few different places, between Morgan Stanley. I was at Panmure, I was at Arbuthnot as well back in the day. So I had a few different pension pots. So one of the first things I did actually during COVID was, and a lot of people would have done this admin, I think, was put the pots together into one to make it more manageable. And that's, that if anybody can do that, actually one of my colleagues was telling me that his wife did that during COVID as well. That was, so I think that was a bit of a moment. I think people hit sort of around 40 and say, actually, this pension thing is now closer than it seemed before, and start getting organised. So it used to be the pot of money I'm never going to be able to spend, and now it's actually I need to make it, so that I live in the standard I'm accustomed to down the line, whether that's age 70, 75, who knows.
Brilliant. Yeah, that's a very good thing to have done. Now, I want to touch on the piece of research you did for the London Stock Exchange, Jean. You mentioned already, the dividend on the trust that you run, and the fact it's compounded the dividends over the years. But you did a piece of research regarding multi-baggers with James for the London Stock Exchange, and just share with us, if you can, so I'm conscious of the time that we've got left, some of the nuances of what the findings were and the multi-baggers that you did find.
Yeah. Okay, so for anyone who's not familiar with multi-baggers, Peter Lynch was the guy who originally talked about this, and you can look that up online. But my colleague James did a bit of work on 10-baggers, and then I was asked to do about a year later, I was asked to do something for the 30th anniversary of the FTSE 250, and I thought, why don't we look at 30-baggers? And I saw there that the UK had a higher proportion of 30-baggers than the US. And that was interesting in itself. And so then the next question is, okay, Jean, so that's looking backwards. So in order to help us move forwards, what are the characteristics of these 30-baggers? And one of the things that we found was that they were companies where management had not issued many shares. So the share count keeping down. And I mentioned Man Group earlier, and they've been buying back significant number of shares, up to 20% of their share capital. So not issuing shares, bolt-on deals tended to be a characteristic. But also an interesting characteristic was it didn't have to be going up in a straight line. It can, there could be lulls as well. And it tended to be in a sector where there wasn't significant competition usually, or certainly, and also they would tend to be maybe reinventing themselves, being nimble, and management teams where they would move around in different, out of one sector into another. But I think the very noticeable one was that, equity is expensive. So not issuing lots of shares was a significant feature. Now, some of them would have done a number of deals over the years that might have been paid for partly in shares, partly in cash. But that was very much, a recognition of how expensive equity is. Was a big part of it, but the UK tended to be very good, particularly at we found had a bit of a cluster of multi-baggers around the sort of high skilled engineering side of things, and I suppose that goes into the fact that the internet was invented really in the UK, and that sort of that talent, we see it with fintech now as well. That happens to exist here, but sort of very highly skilled, high value added engineering. A number of the multi-baggers were tilted in that direction, but they've been all sorts of sectors. And we have 4 podcasts which we've recorded, 3 with CEOs of mid 250 companies, 2 are multi-baggers, and then a more general around the theme of multi-baggers. So if you wanted to hear more about it, James and I have done a fair bit on that. So, but yeah, I mean, I think the quest for the multi-bagger, isn't that what all of us investors are trying to hunt for, truffling for them?
Absolutely, we are. Now, I love the fact you covered multi-baggers, but there's something else I know that's very, very close to your heart, because you've been working in the city for as long as you have, and you're one of the top fund managers that we do have currently as well, and hopefully for another two or so decades. For as long as your pension pot can go to. So let's talk about diversity and inclusion. You mentioned when Andy was looking to recruit, he wanted to have a female on the team, and he made a very good choice in yourself. He was very, very lucky to be able to have the opportunity to pick you for Schroders. But you started to do some work with Dame Helena Morrissey. And I want you to talk about that world-leading project, please, because you mentioned also that you watched the previous podcast that I did for Investing Matters with Alexandra McGuigan, and we spoke about inclusivity and diversity on that as well. So tell us about that project. It started last January 2023, and what happened in the first year, and what resonates with you regarding that project, please?
So yes, back in January 2023, the programme was launched in a very drafty Canary Wharf in the HSBC building there, and we started with 60 participants from various asset management houses. Each would have a sponsor, and they would go through sort of an MBA-like programme with very sort of modules in things like building a portfolio, what drives financial markets. Quite in many ways, the softer skills and the more crunchy financial skills of being an investor. And it was, it's the idea is to take people from all sorts of backgrounds. Well, they'll already be, financially, professionally qualified. They might be accountants. They might be working in risk. They might be working in operations. And, it helps them to decide over the year, whether they would like to be a fund manager, because we've got this problem with only 11, 12%, depending on how you count it, of fund managers who are actually controlling, buying and selling assets are female. And the idea is to try and bring more of them through. So last year, we had 60 graduate, shall we say, from there. And actually, I'm proud to say Schroders was one of the first firms to sponsor it as well. And this year we have another cohort coming through. And my own involvement has been, fairly light touch. But the main part has been, I've been on the launch panel both years, and I've, under sort of Chatham House rules basis, just spoken about my background and what brought me to fund management. And then the people in the audience can ask questions, and it tends to be the sponsors and the sponsees as well. And for example, Schroders has 2 people in this year and did have last year as well. So it's a concerted effort to do something really practical about the diversity problem we have. And it's only one aspect of diversity, obviously. It's the lack of female fund managers. It doesn't address every other aspect, but it's a really good start. So I'm really happy to support it. And, I think, you can do a lot of talking, but it's a very, very pragmatic way to address the issue. And then, people can see, do I actually want to become a fund manager? And, and it makes it accessible to people who might not be that obvious for when they're, at a certain point in their career. A lot of them are sort of 5-6 years in. And I'm very hopeful that it will inspire a new cohort to come into the profession.
I think it's a phenomenal piece of work, Jean, and yourself, Dame Helena Morrissey, and others that are doing it are going to inspire so many young individuals into the industry, I think, and maybe some that didn't think they'd want to be a fund manager in essence as well. So please keep up that piece of work. I love it, and if I can be of any help as a male, sponsor, I'm happy to do that as well. I've got a. You're welcome. I've got one final question. I'm conscious of the time, and I've had to cut out a lot of other questions as well, to get to a bit of a fun question for you. The final question, Jean. I'm going to currently grant you complete power and autonomy over the investment industry. I'm going to ask you, what would be your immediate changes that you would make for the betterment of all and for future generations of investors, Jean? You've got complete control now.
Okay, well, it's a really easy one, actually. I would change the hours of the stock market. I don't think it needs to be open from 8 till 4:30 in the UK. So I'm just talking about the UK. I think it used to be open at either 9 or 9:30. I'm not sure which. So that, I think, would open the career to more people. And I think, I don't think it would be that hard to enact, although, there will be people who probably would strongly object to it. I feel that it would just make it a bit easier for more people to be involved. Because I think particularly it's a UK issue as well. Individuals don't tend to be so engaged with the market. And I think, listening to Alexandra in Australia, people seem to be more actively leaning into their investment futures. And in the US, we know they certainly are. So that's sort of the UK industry. So that is the single thing. I think I would just move it to 9 o'clock, see what happens.
Brilliant. I love that. I've not heard that reply before. I think that would be a game changer, I think. I really, really like that answer, actually. Thank you. I hadn't thought of that. Why didn't I think of that? Thank you, Jean. Oh, brilliant. That has been absolutely fantastic speaking with you. Ladies and gents,
you too.
That was my special guest. I've got to say special because you actually have been an absolute diamond for the industry and a fantastic find. And I'm glad we didn't lose you to French lessons and something else out there, although that's important as well. I'm glad you became in the investment industry. So, ladies and gents, that was Jean Roche, the lead manager of the FTSE-listed Schroder UK Mid Cap Fund, 1/3 of the UK Small Cap team with Andy Brough and James Goodman. And Jean, I must wish you as well good fortune, and it's a huge task ahead of you when you become a member of the UK takeover panel forthcoming. I think you start next couple of months. So if you can safeguard any other companies from being taken over and, gone, please do your very, very best.
I'll be looking at shareholders.
Absolutely. Ladies and gents, Jean Roche of Schroders. Take care, Jean. Thank you very much.
Thanks for the chat, Peter. Pleasure. Bye-bye.
Bye-bye.
Thank you for taking the time to listen to Investing Matters. Be sure to check out the London South East website for free tools and info to research your next investment. You can also join in the conversation on our social media channels. And don't forget to subscribe to our YouTube channel for more content, including our CEO interviews. Catch you next time.